Debt isn't always a burden. For many of the world's wealthiest people, it's a powerful tool, a strategic lever that turns opportunity into lasting wealth. Hello, and welcome to FluxFolio Finance. Today, we're breaking down how the rich use debt to grow even richer, not as an emergency measure, but as a deliberate plan to build assets, amplify returns, and reduce taxes. For most people, debt feels like something to fear. Credit card balances that never quite disappear. Student loans that stretch for decades. Mortgages that strain budgets. But the wealthy see debt differently. They treat it as capital, a way to control bigger assets without tying up their own cash. Think of debt as a lever. The classic image, a long beam balanced on a fulcrum. Push one end gently, and you can lift something massive on the other. In finance, debt amplifies your buying power. One of the clearest examples is real estate leverage. Instead of buying a property outright, you put down 10–20%, and a bank finances the rest. When the property's value rises by 10%, your actual return on the cash you invested can be far higher, sometimes near 100%, depending on the loan terms. This strategy scales. Investors use equity built in existing properties to finance new purchases. Refinancing unlocks capital tax-free, which can be reinvested. The process repeats, turning one property into a portfolio. This isn't just theory. It's common practice in real estate. Many property investors don't get rich by saving every penny. They grow wealth by controlling more appreciating assets through borrowed money. Debt also powers business growth. Corporations routinely use debt to expand, hire, acquire competitors, or launch new products. They finance growth without diluting ownership. Interest payments are often tax-deductible, reducing the real cost of borrowing. This approach isn't limited to giant corporations. Small businesses do it too, taking loans to buy equipment, hire staff, or enter new markets. Strategic borrowing turns into increased revenue that covers the debt and then some. Another common wealth-building method is using home equity lines of credit, HELOCs, or mortgages strategically. Instead of paying off a home and letting equity sit idle, wealthy homeowners borrow at low rates against that equity to invest elsewhere. The goal is to earn higher returns than the cost of borrowing. The same logic applies to margin loans in the stock market. Investors with large portfolios can borrow against their holdings to buy more shares. When markets rise, returns are magnified. Corporate finance relies on these principles too. Companies issue bonds, borrow from banks, or tap private credit markets to fund expansion. This reduces the need to use internal cash or issue new equity, preserving ownership and control. Debt can also reduce taxes. Interest is deductible, lowering taxable income. For corporations and individuals alike, this makes borrowing cheaper than it appears at face value. One of the most discussed strategies among the ultra-wealthy is the buy, borrow, die approach. 1. Buy appreciating assets, real estate, stocks, art. 2. Borrow against those assets instead of selling. 3. Use borrowed funds for lifestyle needs without triggering capital gains taxes. 4. Upon death, heirs inherit with a stepped-up basis, eliminating the accumulated capital gains liability. This strategy turns debt into a tax shelter. Borrowed money isn't income. It isn't taxed. Assets keep appreciating. And after death, the gains can vanish for tax purposes. It's a legal method used by the ultra-rich to avoid selling assets and paying capital gains while still enjoying their wealth. Meanwhile, many middle-class households use debt differently. They borrow for depreciating assets, cars, consumer goods, high-interest credit cards. These debts don't create income. They don't appreciate in value. They become a drag on net worth instead of a way to expand it. The difference isn't just access to capital, it's mindset and strategy. Wealthy borrowers carefully manage leverage. They match debt to income streams. They hedge risk. They diversify. But leverage is never risk-free. Debt amplifies outcomes in both directions. When asset prices rise, gains are magnified. When prices fall, losses deepen. A property decline can wipe out leveraged equity fast. A downturn can trigger margin calls. Smart investors understand this. They plan for worst-case scenarios. They avoid overextending. Debt is a tool, like fire. It can cook your meal or burn down your house. It's not inherently good or bad. It's about how it's used. Debt doesn't just help the wealthy buy assets. It lets them engineer entire deals, build companies, and even influence markets. One of the most striking examples is the leveraged buyout, or LBO. This is when a private equity firm uses borrowed money to acquire a company, often financing 70 to 80% of the purchase with debt. The loan is typically secured against the company's own assets and future cash flows. After the acquisition, the firm restructures operations, cuts costs, and improves profitability. Eventually, they sell the company at a higher valuation, paying off the debt and pocketing the profit. A classic case is the 1989 KKR buyout of RJR Nabisco for $31 billion, at the time the largest LBO in history. The debt was massive. The deal was controversial, but it pioneered a model that private equity still uses. Or take the Blackstone-Hilton deal in 2007. Blackstone acquired Hilton Hotels using around $26 billion in debt. Despite the 2008 financial crisis, they navigated the downturn and ultimately took Hilton public in 2013, making roughly $12 billion in profit. But leverage cuts both ways. When markets turn, debt magnifies losses. Energy Future Holdings offers a sobering example. Its massive debt-fueled buyout collapsed when energy prices fell, leading to one of the largest bankruptcies in U.S. history. Beyond acquisitions, private equity firms use debt in dividend recapitalizations. They load portfolio companies with new debt and use the borrowed funds to pay themselves dividends. It's a way to extract value quickly, but it can leave companies vulnerable to downturns. The buy, borrow, die strategy is another debt-based approach used by the ultra-wealthy to minimize taxes. 1. Buy appreciating assets like real estate, stocks, or art. 2. Borrow against them for living expenses, avoiding capital gains taxes since loans aren't taxed as income. 3. Hold the assets until death. Heirs inherit them at a stepped-up basis, wiping out the capital gains liability. It's perfectly legal, and it illustrates how debt becomes not just a tool for growth, but a strategy for avoiding taxes. Corporations use debt strategically too. They issue bonds to raise capital for expansion without diluting ownership. They use loans to fund R&D, acquire competitors, or invest in new markets. Interest payments are often tax-deductible, reducing the effective cost of borrowing. Debt can improve returns on equity by leveraging the company's balance sheet, but only if managed carefully. But for all these advantages, leverage is never risk-free. Debt amplifies outcomes. It can turn a small profit into a massive windfall, or a minor downturn into a financial disaster. This is why wealthy individuals and firms manage leverage with discipline. They diversify income sources, match loan terms to expected cash flows, maintain liquidity buffers, to stress test their portfolios against market downturns. They understand that credit is a promise to pay. That promise is easier to keep when there's planning, cash flow, and diversification behind it. Meanwhile, many ordinary households use debt for consumption, high-interest credit cards, auto loans on depreciating cars, student loans for degrees with unclear payoffs. These debts don't create income or appreciate in value. They can become financial traps instead of stepping stones. The lesson isn't that debt is bad, it's that debt is a tool. Used wisely, it funds growth, investment, and opportunity. Used poorly, it drains resources and limits options. Financial literacy is the key difference. Understanding how to borrow strategically, knowing the difference between good debt and bad debt, evaluating interest rates, terms, and risk. Even for those without millions in assets, these principles matter. Buying a home? Think about the leverage ratio and interest rate. Starting a business? Plan cash flows to service the loan. Investing? Avoid overextending with margin in volatile markets. Debt is neither friend nor enemy. It's a force that magnifies your strategy. It rewards planning, punishes recklessness. The wealthy know this. They build systems to manage it. They turn debt into a lever, lifting their wealth higher than savings alone ever could. Thank you for spending time with FluxFolio Finance. If you found this helpful, subscribe for more clear, practical insights on how the real economy works and how you can make it work for you. Until next time.